Right now, as you're watching this, your money is losing value. Not slowly, not eventually, right now. Every dollar you've worked for, saved, and invested is being quietly devalued by a system most people don't understand. But what if I told you there's an alternative that nobody can control, manipulate, or inflate away? That's cryptocurrency. And today, we're explaining it like you're 5 years old. Imagine you're standing in a grocery store in 1970. You have $100 in your pocket. You could buy a month's worth of groceries, fill your car with gas 4 times, and still have money left over. Now fast forward to today. That same $100, maybe 1 week of groceries if you're lucky. The money didn't change, its value did. Someone somewhere decided to print more money, and suddenly what you had was worth less. This isn't a conspiracy theory, it's monetary policy, and it happens every single day. Here's the thing most financial experts won't tell you outright. Traditional money isn't backed by anything tangible anymore. Not gold, not silver, not physical assets. It's backed by trust in governments and central banks. And when that trust gets tested, when policies prioritize short-term fixes over long-term stability, the people who suffer most aren't the wealthy with diversified assets. It's everyone else. The savers, the retirees, the people who played by all the rules. This is where cryptocurrency enters the conversation, not as a get-rich-quick scheme, but as a fundamental reimagining of what money could be. Picture a sophisticated investor sitting in their office, portfolio in hand, reviewing decades of financial history. They see the patterns, the 2008 financial crisis, the 2020 money printing, the consistent erosion of purchasing power averaging 2 to 3% annually, sometimes much more. They're not looking for gambling opportunities, they're looking for protection, for alternatives, for systems that can't be manipulated by central committees making decisions behind closed doors. They're asking a simple question: what if money could be governed by mathematics instead of politics? Cryptocurrency, at its core, is embarrassingly simple. It's digital money that exists on a network of computers instead of in a bank's database. But here's the revolutionary part. No single person, company, or government controls it. The rules are written in code. The supply is predetermined. The transactions are transparent. It's like having a financial system where everyone can see the rule book, verify the math, and know with absolute certainty that nobody's printing extra money in the back room. For investors tired of monetary policy uncertainty, that's not just interesting. That's potentially transformative. Of course, not everyone's convinced. Skeptics see cryptocurrency and think it's digital tulip bulbs, a speculative mania destined to collapse. They point to volatility, to scams, to the Wild West nature of early markets. And they're not entirely wrong, but they're also missing something crucial. Every transformative technology looks reckless in its infancy. The internet in 1995 was full of scams and skepticism too. The question isn't whether crypto has problems. It's whether the underlying innovation, the concept of decentralized digital scarcity, solves a real problem. And when you understand how money actually works today, that answer becomes fascinating. So let's start at the very beginning. To understand cryptocurrency, you first need to understand what money really is. And that story might surprise you. Most people never question what money actually is. You work for it, spend it, save it, but if I asked you to define it without using circular logic, could you? Money isn't paper, it's not gold, it's not even really value. Money is a shared belief system. And once you see it that way, everything about cryptocurrency starts making perfect sense. Think about ancient civilizations. A farmer needed to trade his wheat for a blacksmith's tools, but the blacksmith didn't need wheat right now. So communities created something everyone agreed had value: shells, beads, eventually metal coins. The material didn't matter. What mattered was collective agreement. Fast forward to the 1930s, and money was still backed by gold. You could theoretically exchange your paper dollars for actual gold from the government. Then in 1971, President Nixon ended that. Suddenly, money became purely faith-based. The paper in your wallet has value solely because everyone agrees it does, and the government says it's legal tender. Here's where it gets interesting for investors. If money's value comes from collective belief and government backing, what happens when that belief weakens? What happens during hyperinflation in Venezuela, where money loses value hourly? What happens when governments freeze bank accounts during political crises? What happens when central banks print trillions in emergency measures? The system works until suddenly it doesn't. And the people asking these questions aren't doomsday preppers. They're portfolio managers, business owners, and financial strategists looking at systemic risks that traditional finance pretends don't exist. Traditional bankers will tell you the current system works fine. They'll point to stability, insurance, regulations, and for most people, most of the time, they're right. Your local bank is probably safe. Your deposits are insured. The system has safeguards, but those safeguards exist because the system needed them after repeated failures. The 2008 crisis wasn't a one-time accident. It was the system working exactly as designed. Profits privatized, losses socialized. Banks gambled with depositor money, crashed the economy, and got bailed out with taxpayer funds. That's not a bug. That's a feature. This is the context cryptocurrency emerged from, not as an attack on finance, but as an experiment in alternative architecture. What if you could create a monetary system where bailouts were impossible, where the rules couldn't change based on political pressure, where your account couldn't be frozen without due process, where the money supply was programmatically limited, making inflation mathematically impossible? These aren't hypothetical questions anymore. Bitcoin, the first cryptocurrency, has been running for over 15 years, processing billions in transactions, with zero downtime and zero central points of failure. That's not speculation. That's a working proof of concept. So investors started paying attention. Not the gamblers looking for quick returns, but serious capital allocators asking fundamental questions. If a portion of your portfolio is insurance against systemic failure, against currency debasement, against geopolitical instability, what's the right hedge? Gold has been that answer for centuries. But gold is physical, hard to transport, difficult to verify, and impossible to send digitally. Cryptocurrency offers something radical. The scarcity and unconfiscatable nature of gold, combined with the speed and divisibility of digital money. It's not replacing traditional finance. It's offering an alternative when traditional finance breaks down. But here's what nobody explains clearly. How does this actually work? How do you create money that nobody controls? That's where things get brilliant. Imagine you and 9 friends want to track who owes who money without using a bank. You could keep a ledger, a notebook, where every transaction gets written down. But here's the problem. Whoever holds that notebook could cheat. They could erase entries, add fake transactions, or claim it got lost. You need something incorruptible. That's blockchain, and it's simpler than you think. Instead of one notebook, everyone gets an identical copy. When someone makes a transaction, it gets broadcast to everyone. All 10 friends check their copy, verify the math adds up, and if the majority agrees it's legitimate, everyone writes it down simultaneously. Now there's no single point of failure. To cheat, you'd need to convince the majority to lie, which becomes mathematically harder as the group grows. Bitcoin doesn't have 10 friends. It has thousands of computers worldwide, all maintaining identical copies of every transaction ever made. That's the blockchain, a distributed ledger where trust comes from mathematics and consensus, not from authority. But that's just the ledger part. The genius is in how new money gets created and who gets to add transactions to the ledger. This is called mining, and it's where the system becomes truly decentralized. Miners are computers solving complex mathematical puzzles. The first one to solve the puzzle gets to add the next block of transactions to the blockchain and receives newly created cryptocurrency as a reward. Here's the brilliant part. The puzzles are designed so they take about 10 minutes to solve, regardless of how much computing power exists. And the reward gets cut in half every 4 years, creating mathematical scarcity. You can't print more Bitcoin. The code won't allow it. Tech entrepreneurs saw this and recognized something profound. For the first time in history, you could create digital scarcity. Before blockchain, anything digital could be copied infinitely. Music files, documents, images, all perfectly replicable. But cryptocurrency solved the double spend problem. How do you prevent someone from spending the same digital dollar twice? billions for drug cartels. Deutsche Bank facilitated money laundering for Russian oligarchs. Major banks paid hundreds of billions in fines for everything from mortgage fraud to sanctions violations. If you believe cryptocurrency has even a 5 to 10% chance of becoming a major global asset class, and you can tolerate the volatility and risk of complete loss, then allocating 1 to 5% of a portfolio creates asymmetric upside. If it fails, you understand. Here's what 15 years of cryptocurrency have proven beyond doubt. It's not going to make you instantly wealthy without effort, risk, or luck. The life-changing gains happen for early adopters who bought Bitcoin under $1 and held through years of uncertainty. That window closed. Current prices already reflect mainstream awareness. You're not early anymore. You're participating in an established, volatile asset class with uncertain future prospects. The everyday person hoping cryptocurrency will solve their financial problems needs to hear this clearly. It won't. If you're struggling with debt, you need a budget and income growth, not speculative assets. If you're behind on retirement savings, you need consistent investing in diversified funds, not crypto gambling. If you don't have an emergency fund, that's your first priority, not chasing the next Bitcoin. Cryptocurrency might be part of a sophisticated portfolio for someone with their financial fundamentals handled. It's not a substitute for those fundamentals. Anyone selling it as quick wealth is either ignorant or malicious. The path to financial security remains unchanged. Earn more than you spend, invest the difference consistently, avoid debt, maintain emergency reserves. Boring? Absolutely. Effective? Proven across centuries. That said, for investors with surplus capital, risk tolerance, and genuine curiosity about technological change, cryptocurrency represents something fascinating. Not as a shortcut to wealth, but as participation in a live experiment reshaping finance. The intellectual exercise alone has value. Understanding how blockchain works, how decentralized systems create trust, how programmable money enables new applications, these insights apply beyond cryptocurrency. They're fundamental to understanding how digital infrastructure is evolving. The financial upside is speculative. The educational upside is guaranteed if you engage seriously. That might be the most valuable aspect nobody discusses. So where does this leave serious investors? With cryptocurrency as one option among many for portfolio diversification, with realistic expectations about risk and reward, with commitment to ongoing education, and with acceptance that outcomes remain genuinely uncertain. Some will allocate nothing and be perfectly fine. Some will allocate small amounts as speculative hedge. A few will dive deep into the technology and find opportunities in the emerging ecosystem. None of these approaches is objectively wrong. They reflect different risk tolerances, different levels of conviction, and different investment timelines. What matters is honest self-assessment about which category you belong in, then acting consistently with that self-knowledge. The uncomfortable truth is cryptocurrency won't revolutionize finance overnight, won't make everyone wealthy, and won't solve systemic economic problems without creating new challenges. But it has proven it can offer an alternative to traditional finance for those who need it, can provide exposure to emerging technology for those who want it, and can demonstrate that decentralized systems can actually work at scale. Whether that's enough to justify its existence long-term depends on factors nobody controls. Regulatory developments, technological improvements, competitive alternatives, and shifting social attitudes toward privacy, decentralization, and trust in institutions. Making predictions with confidence is foolish. What's not foolish is understanding the space well enough to recognize opportunities and risks as they develop. So the investor who started this journey asking whether cryptocurrency made sense has their answer. Not a simple yes or no, but a framework for thinking clearly about a complex, evolving situation. They understand what cryptocurrency is, why it exists, what problems it solves, what risks it carries, and how it might fit into a sophisticated portfolio. They know the difference between informed speculation and reckless gambling. They can separate signal from noise in a space filled with both genuine innovation and obvious scams. Most importantly, they know what they don't know, and they're comfortable with that uncertainty. That's not just cryptocurrency literacy, that's financial maturity. Now you have the same understanding. What you do with it is entirely up to you.